Hey, what's up YouTube? Kenny here, and today we're going to go over a quick market recap. We're going to talk about the S&P 500, then we're going to talk about Amazon, and then we're going to talk about some sector rotations that are setting up. We're thinking about shorting utilities here. We're not thinking about it, we did it, and we're going to show you kind of our thesis behind it. Tech is still selling off, still peeling, so we're going to go ahead and let that kind of fall to the floor before we pick it up. That said, GDP spend is actually down. It's doing the down thing. It's deteriorating, so we're going to take a look at some JP Morgan data that came in as well. So if you're new to this channel, Redcliffe Research is an independent research firm that uses a lot of quantitative analysis, mostly alternative data sources to kind of bring that signal to noise for you. Also, we steal other people's stuff. Not steal. We borrow other people's stuff that they share to us. Take a look at it and try to get some sense out of it. Anyways, this is S&P 500. What I'm trying to show you is this green kind of circle is the 50 and the 200 here. Simple moving averages. Under a lot of pressure. Again, anytime we're under here, it just seems to always degrade pretty massively. And so we're in degradation mode for sure. The only saving grace here was there was a bullish print here on this bounce, but we have a double bottom indeed right now, and if so, definitely can peel to the downside. Not quite a head and shoulders, but I mean, it kind of tried to do something here. Could we recover? Absolutely. We're at a 412 level right now. We were calling for 418, but you can see here 1, 2, 3, 4, 5, and you know, as it came through, obviously tried to get its footing. So footing here is possible, but when you see this much volatility in a whipsaw like this, this is pretty severe. So you know, the farther the jump or the farther the momentum and the inertia, the faster it can kind of come down. So we're looking at 392 is really the next sensible kind of support, but honestly we're looking at 380 before kind of the peel and the bounce. You know, we might stabilize here, but you know, there definitely might be some more downside. The one thing that I want to talk about though is GDP spending. And that's kind of been like the engine that could, the thing that can keep us from a recession. But it doesn't seem like it's playing ball right now. The CPI print plus the GDP, not looking good. But we'll look at consumer spending and see if it can kind of normalize it for us, kind of maybe wash that out. But here's a chart showing asset managers with leverage and asset managers that don't have leverage. I'm showing you this because in the black, asset managers with leverage looks like they have kind of started degrossing or kind of defunding some of these positions. Basically, they're de-risking their portfolios. The other side of the coin is other asset managers, the ones that are not leveraged, are looking to start to nibble. So you can kind of see in terms of managing risk, you know, obviously they have the long tail here, the asset managers with leverage. So they're going to wait for probably a better opening. But these folks here, nominally, they can be more of an average down type of trading style. So obviously they are starting to deploy funds. Amazon shares fall by 14%. So 14% after the close on Friday. This is the worst day since 2006. Company gave light guidance, but the thing is, if you didn't know, they own Rivian, and that investment, well, you know, that $7.6 billion loss on their investment in the EV maker Rivian. So, I mean, yeah, I saw a lot of bad news coming in through Rivian, even through just our Slack chat. There was a bunch of folks that had Rivian orders that, you know, tried to take it back, but you know, there's a lot of bad customer service in terms of the Rivian orders, pre-orders. I'm sorry. Okay, so this is Chase consumer spending. What I'm trying to show you here is card not present versus card present, online shopping versus not online shopping. You can see here that card present peaked and tried to recapture 2019 pre-pandemic. Not quite there yet. Kind of rejected. So it looks like people are still staying home a little bit, but you can see card not present. That print is well over this kind of mean average over here, pre-pandemic level. So that's a good thing. Not quite here where they pulled forward all those earnings for Amazon, as you can see here, but you know, still very elevated. Okay, so this is showing again kind of the same thing, but this is Open Table versus TSA. These are two data sources. All it's trying to show is restaurants versus flights. Flights still not back over pre-pandemic levels, but you can see here 0%. This is normalization here, and so you can see that, you know, in terms of going out to eat, check mark, people are going out to eat. Another reason that we took that McDonald's trade, even though they did get blasted because of the their inability to service Russia. Okay, so or their choice. This is XLE, XLK, XLU. So XLE is energy, XLK is tech, and XLU is utilities. This is a very long, this is the 1 year chart. And as you can see here from the 1 year chart, XLE energy up 56.8% looks toppy, and it may be, but based on our macro research and based on the things that we're looking at, we do think energy still has a lot more upside and is totally fine to drive from here. That said, utilities not in the same category, not in the same boat, or we are looking to short utilities. So you can see here, definitely under pressure and looks very toppy. We're going to zoom out and kind of show you what that looks like. I'm comparing this to tech because, geez, if you've never been through a sector rotation, you might be like, hey, why is tech not outperforming? It's growth. It's growth. Hey, buddy, welcome to the stock market. But anyways, we'll square you away. So what I'm trying to show here is there's an interesting kind of confluence. Really is. So this is 22 years back, really back to 1999, 23 years, if you will. But look, everything is normalized here. So this is what I would call a wash. So, I mean, if you were in energy for 20 years, and if you were in utilities for 20 years, and if you were in tech for 20 years, everything is hitting ahead and everything is kind of where it should be. All is right with the world according to Thanos, and that's where we're at right now. All right, so this is NEE, Next Era Energy. It was a utilities company. We literally took a position right here. We took it to the upside with very leveraged options. We closed out exactly right here 2 days before this topping pattern. We said this looks like a head and shoulders pattern. We called it perfectly. We took it down twice. We took it down, got out here, reopened, got down again over here. I did try to scalp a move to the upside just in case. But then we canceled that leg, and now we have a leg coming down to the downside. This one is a longer one that we usually do. We usually typically go for 45-day options because that's generally the best risk to reward and optimal according to our trading style. But that said, trajectory right now, if this is indeed a head and shoulders, you do know head and shoulders goes down here, and it could definitely gap fill down to the $59.28, which would be substantial. So we bought very, very out of the money puts here, just raw puts, no spread, no anything. But we're going to talk about how we're setting that up and why we think this is the play. So NEE, I looked at it, I said, hey, it's either going to bounce here or is it going to go to the downside. Obviously, 68% chance it goes to the downside because head and shoulders pattern, 68% chance. So we got a greater affinity for it to go down. But I said, hey, macro-wise, does this make sense? Is this the one that we short, or do we short the XLU? So I took a look at it, and this is a scatter plot showing on the x-axis, this is price, and on the y-axis, this is price to earnings. The thing is, I'm sorry, the reverse. Price to the right, up to the top is price to earnings. So anything up here would be the most toppy. And so you can see here, NEE sits alone. Why is it getting more love than all the other ones? Not sure, but just remember, if it's just a PE game, NEE is definitely overrated. Obviously, there's other things that you want to take a look at, but all things being equal, it seems like everybody else is getting a sensible treatment reference PE, and that's about 20 times for a utilities company, but everybody is crowding into NEE. So when everybody crowds into a stock like this, sentiment-wise, PE is a proxy for sentiment. When everybody crowds in, it can definitely do the down thing. So we are still short, and at 100 PE, it could definitely come down actually 4 times if you think about it, 5 times really. But we're not asking for that much. If it gets cutting half here, it comes down to a PE of 50. It will get a little bit closer to some of these other companies, which would be fine and keep it out of the race. So halfway down could definitely happen. We're not asking for all that, but we are definitely betting on some of that. So if you take a look at the discounted cash flow, again, based on just the DCF model, fair value $52, so it could definitely come down a bit. That's a 30% downside there. So even if you come down from here at 100 PE, let's say, more or less, it's saying fair value is literally here on a discounted cash flow. Okay. If you look at the other metrics, again, this is the only one that I'm really looking at. Yes, they have a good compound annual growth rate. It's fine. Revenues are kind of declining though, and this is coming out of the new fourth quarter, not the new fourth quarter print, but the new earnings report. Levered free cash flow doing just fine. I'm not going to go over all of this, but I'm just showing you this to show you that given the PE ratio, And the revenue decline, not the best mix. I'm sorry, compound annual growth rate of only 1.1% now. All right, that is it. That is it, boys and girls. Hey, for you last 5-minute crew, tomorrow going to have a nice live stream. If you want something covered, put it in the chat right now, and we will put it in the live stream. We'll talk about it. We got some pretty cool people coming for the live stream, not this week, but probably the week after and the week after that. We do have some special guests. We can talk crypto on the one after this. Yeah, no, we're setting that all up. Hey, I need a favor. People aren't taking me seriously here, so let me go over here. So I asked in the chat. I said, hey, no. I said, guys, I need your help. I made a LinkedIn account, and I put Master Trader as a skill, my only skill. If you have a LinkedIn account, please go endorse that skill. And I put my LinkedIn, and only 2 people took me seriously, and so far only 2 people have endorsed my Master Trader skill. So if you're bored and you have a LinkedIn, I'm going to put the link in the description, and go endorse Kenny, your boy, for Master Trader, if you would. Thank you, and have a nice day. Thanks. We'll see you tomorrow.